There we go. I think we're live and I think we're recording, which is great. Welcome, everyone. Thanks so much for joining us again today. This is our weekly session. I'm hosted by Eason Tan. Eason's our head options trader here at Volatility. And Tuesday sessions we're calling trading technical. So we generally start off with a bit of options theory and then dive into the live markets and trades that Eason has been putting on over the last couple of weeks, just to get an update around how they're all going, how he's managing those trades, and what he's seeing in the market. So we've got a fair bit to cover today. Let's get into it. But, as always, everyone, we love to keep these sessions as interactive as possible. So please, if you have any questions for Eason, make sure you type them into the comments. If they're relevant, we'll get to them as we go. If there's any other questions, we'll try to get to them at the end. I know we got a bit off topic last week, Eason, and we went on a little bit of a rant, but we'll try and keep it concise and relevant. But any questions are welcome. So please type them into the chat and take advantage of while Eason is here taking time out of his day to educate us all. As always, any information contained within these presentations are general in nature, and these sessions are for educational purposes. Past returns are no indication of future returns. And please, if you're new to options, make sure you understand options and how they work before you start trading. They can be highly leveraged, high risk, uncapped losses. So please make sure you understand options, how they all work before putting your hard-earned money into the market. Come along to these sessions. That's what these are all about, to educate you all. Use our simulated trading accounts within our system as well, and ask you questions. We're more than happy to help from our side. Okay, Eason, today I know you were pretty keen to talk about arguably the most important factor for options trading, implied volatility, and how that affects options trading and the strategies that you do put on. For anyone wanting to learn more around our previous education series, and I probably should have just mentioned this at the start, last week we covered the Ichimoku cloud, one of Eason's favorite indicators. Previous weeks we had a look at the MACD indicator, goal setting, risk management, a couple of the highlights of our previous sessions. So if you're wanting to learn a little bit more around that, be sure to check out our previous videos, and I'll show you where to find those when we jump onto the platform a little bit later on. But Eason, I know you're here to talk today around implied volatility. I know the general sentiment in the options market is buy options when implied volatility is low, sell when implied volatility is high. Maybe you have some contradiction to that, but interested to hear around your views around how you navigate implied volatility when you're trading.
Yeah. So look, implied volatility, with regards to options, is probably the most talked about thing. It is arguably, the most important thing, when looking at options. But I feel that there's so much information out there. They talk about the mechanics, and what it is and how it is, right? But I think there are some things, that people overlook, right? And sometimes, convention, is one thing, right? But there are always outliers. I'll call them for the moment. But I'll go through that, as the presentation goes on. So, in terms of implied volatility, right? What is it? Just click onto the next one, please. All right. Implied volatility, refers to the market's expectation, of a security future volatility, right, as implied by the price of its option. Okay, so we look at the price of the options, right? It will spit out a number, right, and it will tell us, what we think or what we expect, that the stock's going to do into the future. All right. Now we all know, it has a direct impact on the price of the option. So generally speaking, higher implied volatility means that you get higher option prices, and low implied volatility means obviously your option prices are lower. All right. It is the market's expectation of what price may do into the future. All right, but obviously expressed as a number. Okay, but before we go into a little bit deeper, I want to talk about well, I'll show you in the next slide. Okay, I think it's very important. Right? I think this slide is very important. Just going through the anatomy of an option. Okay, obviously that's the rectangle. You have your time value, and you have your intrinsic value. Okay, the implied volatility component, all right, only affects the time value. Okay, and that's obviously diminishing over time. All right, with regards to the intrinsic value, right, implied vol right now has no effect. Okay, so what will happen right now is at expiry, you're going to be left with the intrinsic value. All right, the time value will all disappear, and then implied vol right now means nothing. Right at the end. Okay, so this will play into right now, right, the controversial bit that I want to talk about right now a little bit later. Just click through that. Now, before I talk about right now this comparison, right, whenever I trade options right now, and whatever indicator I'm looking at, all right, I think that there's got to be absolute practicality, right, with whatever I'm reading or whatever I'm doing, right. It's got to ultimately make sense. All right, so I think of implied volatility, right, like looking at support and resistance on a chart. All right, I think of it as a supporting character. All right, it aids me around into my investment decisions. All right, but it isn't the main attraction. All right, it's something that yes, you need to be aware of. All right, and sometimes you'll need to act upon it, and it may change your strategy somewhat. All right, but it's not the first thing that I look at. All right, so as we said earlier, right, conventional wisdom, right, tells us that when we are low in a low implied volatility environment, we should be buying it. All right, and if we're in a high vol environment, right, then we should be selling it. For me, that's only a half truth. All right, so for example, right, when it's low, when we have a low vol environment, right, it's more so that when the vol is high, yes, we want to sell, but the implied vol running only looks at like a single series of option. Okay, so if you were going to say, okay, right now the vol's high and you want to sell naked, right, then yes, you can take advantage of the implied vol because you get a higher price, and that's great. Or if the implied vol is low, right, and I buy a single series option, right, then obviously I want to be a buyer because I'm paying a lower price for what it is, all right, for that particular period. All right, that makes sense. But the thing is, right, let's say I was going to do a spread. All right, so let's say I sell a call spread. All right, so that would be a bear call spread. So I sell, let's say, let's use index as an example. All right, if I sell index at say 7,800 and I buy at 7,900, all right, the implied vol doesn't matter as much whether we're in a high vol environment or a low vol environment. It matters a lot less, because what ends up happening, right, is you will get paid for a high vol position, right, on your sold leg, but you will pay expensive on your protection leg. So once you net out the two, you're not really taking advantage of the volatility anymore, right? Because it's somewhat neutralized already, because you're paying high on one side, right, and receiving high on the other. So it becomes neutral. Right. The other thing right, that's worthwhile thinking about, right, is if we're in a low vol environment, what does that actually mean? Okay, so it says right that that in the future, when the market is not expecting that there's going to be a big move coming through, right, and that could be in the next 30 or 60 days or whatever it may be. All right, so therefore, even if you are buying a call in a low vol environment, right, it's saying, right, that in the future, there's not going to be a lot of volatility, which means that there's potentially, I don't know, not going to be a big move in the market. So, and if you buy a call, then you may not, there's a possibility, right, you may not make a huge amount out of it, right, because the move that's potentially coming through, right, may not necessarily be that great. Does that kind of make sense? All right. So that's where it gets conflicting. All right. Now, of course, right, some will say, well, if you go through periods of, significant compression, right, and the market's been, in a low vol environment for a long time, right, and you're expecting a breakout, and we might be expecting an explosion in volatility at some point. Yeah, yes, that is true, but the problem is, right, does that mean that your option or your time to expiry, right, is it going to happen within the time frame right now that you have your position? All right, because if you buy something kind in there, right, and the market expectation is going to be flat, and you've got a bought call, okay, sure, you're decaying, right, at a lower rate, right, because you paid less for the position. But the thing is, right, at the end of the day, if the market's done, you're still going to lose money. All right, and that becomes a problem, right? Because many years ago, right, like I was reading up on obviously implied vol, right, and people were saying, right, that if the vol's low, right, your best bet, right, is actually to do either a bought butterfly or a bought strangle, right? Puts, right, because it's super cheap, right? And then if you get your breakout, right, it's going to be great. So naturally, right, right, I went out, and that's what I did. But of course, what occurred, right, or what occurred at the time, right, was the market didn't move. The thing, right, continued to flatline, right, and only move a little bit, and ultimately, I still end up losing money out of it, right, because the implied vol was saying, right, that there's going to be no movement. So this is where it becomes a problem. If you put implied vol as your number one most important thing, right, when you put on a trade, that's a problem, right? It's not the most important thing when you actually do a trade. The most important thing, right, is making sure, right, right, that A, you have the direction correct on the market, then you apply, right, your implied vol, right, as a secondary or a third, right, not the other way around. If you run, right, your implied vol first, right, and then worry about your direction after, right, I believe that's the wrong way to go about it. Good iron condor then with low vol. No, so when you do an iron condor, right? Okay, so when you do an iron condor, right, it means you got protection, right, straight off the cuff. Okay, so therefore, right, whether it's high vol or low vol, right, it matters a lot less. Now, of course, I know there's outliers to that, right, depending on how far your protection is away, right? But typically speaking, right, if you say do like let's call it a $1 spread or a $2 spread, right, you negate, right, a lot of the high vol, right? A lot of the high volatility, right, that you would otherwise normally get, right, dissipates.
Yeah, Eason, I guess I'll jump in here, and you made a great point around trading spreads in low implied volatility environment, and I guess I'm just looking at the TLS options chain that you've put up on here, and probably something to consider, and it's very important, is, as you mentioned, when you are trading a spread, the implied volatility. And looking at that metric, you can kind of see the implied volatility skew on the I'm assuming this is the call side on TLS here. So it's probably more important to worry about, when you're looking at this this options chain, looking at the actual strikes that you are selling and buying, and ultimately trying to find where you can sell an option that has a higher implied volatility and you buy an option that has a lower implied volatility, which could give you an extra couple of cents within that trade. Is that something that you look for?
Yeah. this is the other thing, right? And there's a reason, right, why I've put a comparison right now side by side right now between CSL and Telstra, right? So I think everyone knows right now, right, that CSL right now, right, trades, is like a chicken on steroids. Right? It goes up and down on it by a lot, right? So the price movements right now, right, for CSL are very significant. All right, Telstra's on the other side of the spectrum. All right, it basically doesn't move, right? And the premiums are really cheap. All right, so I've put this was only done a couple of days ago, right? So CSL right now, right, has got an IV rank of 4, all right, while Telstra's on 25. Okay, so CSL right now, right, at the moment, right, is at pretty close right now to its lowest, right, implied vol for 12 months. So you would think, right, at this point, right, that if I was going to trade CSL, I should be buying, right, because it's low implied vol, right? So I should be buying positions right now. So whether it be buying calls or buying puts, okay. But if you look at the price, no, this is September, by the way. All right, so I've just chosen September right now, right, to highlight it. All right, now this is an at the money position. If you buy an at the money CSL for September, all right, you're paying $10, all right, or over $10. All right, now that's all time value. All right, so if you think about that, right, now even if you were to do it right in say the spot month, right, and you went out to July, that price right now will still be $5. Now, if you work that out, right, and you go, okay, there's say roughly about 20 trading days, all right, across the month. You then divide that equally, right, by your $5 premium, right, say for the spot month, and you can actually work out, all right, roughly how much time value you're going to lose on your position, all right, on a day-to-day basis. Now, of course, running there, right, it's not obviously on a time decay is not exactly linear, right, and it falls off running there as we get closer to expiry, all right. But I think it's a good rule of thumb running there, right, to gain an understanding running there of what sort of time value you are losing on the way through, all right, and why sometimes running there, other than looking at just implied vol, you've also got to look at the capital component as well, right? Because if you're paying $5, right, and you're losing 30 cents a day, right, in time decay, then you hold it for a week, right? You're down $1.50. You've got problems, you see, right? Whereas if you conversely go across to Telstra, right, and it's got an IV rank of 25, but have a look at it. If you go into September, right, and you're buying at the money, how much time are you paying? I can't even read that, Blake, right? But
8.4 cents.
8.4 cents, right? And that's all time value. So if you think about it, right, like I can take a position out right now for 3 months on Telstra, right, sit on it, right, pay. Look, at 25, obviously it's still cheap time, but it's still high implied vol. But the thing is, I know from a capital component, right, how much money have I got at risk? It's negligible. All right, so that's why I know, right, when I trade a position, right, or when I'm selecting, I know, right, what I want to do. Apart from looking at the implied vol, right, I look at what is this actually going to cost me in real terms. All right, if I take this position out for a month, all right, and I'm paying this amount in time value, right, this is roughly what I'm going to burn, right, on a day-to-day basis. And if this position works, right, what am I expecting? All right, because I can tell you now, running there, right, I've seen guys running there, right, go in, right, and that obviously they don't buy many, all right, but I've seen guys go in running there, right, and pay $5.50 running there, right, for a CSL bought call or a bought put, right. They sit on it for a week, right, they're down $1 straight off the cuff, and probably more, right. You're probably down like $1.50, right, if the stock does not move. All right, the time ticks over really quickly. All right, and then all of a sudden, running there, right, you're 10 days in, right, your position's down to like probably between 250 to 280, right, and it becomes really difficult right now to recover right now from something like that, right, because the amount of time decay, right, that's coursing through it is absolutely massive, right. Whereas conversely, right, if you go to something like a Telstra, right, even in September, right, you're paying 8 cents, or if you go all right, I'll because the actual cost is so cheap, all right, I can actually buy it in the money. All right, let's say for example, right in there, I didn't buy it and at the money. I bought it 30 cents in the money. All right, for 50 cents, I can effectively run in there, take a position out 3 months, right, that has got pretty much running there. You probably have like 75% intrinsic, all right, and a very, very small amount of time. And if the Telstra moves, I'm good, all right, because I'll have I'll have the high delta, all right, and I've got the low time value, right. Whereas with CSL, right, because it's so expensive running there, right, and it's all time value, right, I'm burning right at a rate of knots. So, excuse me, just gonna cough. Sorry, guys. So when I structure running there, right, in particular, running bought calls and bought puts, all right. Apart from the fact running that I want some form of a delta running there, right, and obviously I want exposure because I'm expecting a big move, all right. I also want to try and control the amount of time value that is actually in that particular position, all right, because as I've said in the past, all right, when you go for a bought call, you've got two factors that are working against you, right? A, the stock moves against you. B, the time value goes against you. All right. So if you can reduce that latter component of the time, all right, then you got a much better chance of actually pulling a profit. All right. So that's why I only know when you look at implied vol, there's nothing wrong with looking at implied vol and understanding what it is, right? Because obviously it tells us what may occur in the future. If the implied vol is really high, it means that the movements are going to be great. Okay, so if you use it for that purpose, it's fine. But if you're looking at going, oh, I'm going to go for, I want to trade this position, right, because it's got implied vol, and you apply any strategy to it, won't necessarily work. Right, so you've really got to think about it right, from a practical point of view. All right, how much is it going to cost me? How much is it going to hurt me? Right, if I pay for this. All right, so because think about it, right, even if the implied vol in Telstra was at 75, all right, realistically, right, what's your at risk capital? All right, because the stock itself is not super volatile, right, even on a super high implied vol, you're still not going to get killed right in there, right, even if you buy something expensive. All right, so so in a way, arguably, all right, I manipulate the strikes, right, or I will move my strikes up and down, right, to control my implied vol, right, in terms of what I pay, right, because obviously, right in there, the deeper in the money you go, the more intrinsic value that you have in your option, the less time value it has, the less the implied vol impacts your position. All right. And conversely, right, if you go the other way, all right, where you buy something that's, let's say, either at the money, where it's all time value, or you go something you go worse than that, you go out of the money, right, where you've got intrinsic, you got the price data to catch up to the current price, all right, and then on top of that, then it's got to build intrinsic value, all right. When you pay a high implied vol off the back of that, then you're making things really difficult for yourself. Does that kind of make sense? Right. So let's see. Plenty of information running there, right, about implied vol running and what you should do with it running there, right. I've seen a lot of stuff online and stuff, and they say, oh, if you buy low and you sell high, right, that's the name of the game, right. But I don't believe running there, right, that's 100% true, right. There are some truth in that, right, but it really comes down around right, to what sort of strategy you're applying at the end of the day, and you've got to be really, really careful running there, right, about just running through convention, shall we say.
Sure, Eason. No, that makes a lot of sense, and I agree with you. It shouldn't just be black and white. Buying low implied volatility and selling high implied volatility. You probably need to really think logically as you spoke around, the strategy that you're actually putting on and how the implied volatility is affecting that. And it is a double-edged sword, as you said, because, the implied volatility is the estimate of what the market expects this stock's going to do over the next period of time. And if it's low, the market's expecting there's not a lot of movement within the stock, which means buying calls are going to be cheaper. But in saying that, we know that if you're buying a call, you have time against you and you kind of need the stock to go in your direction as well. So, yeah, it's important and like something to consider. I would, I think that probably the reason behind buying low implied volatility and selling high implied volatility really come from a strategy that makes sense. And that's when implied volatility is really high and you're looking at selling like a cash secured put or a strangle. Because generally, and we do see this often, the market kind of over exaggerates risk. Like, and we can have a look at the implied volatility on the XJO a little bit later, but you'll naturally see implied volatility go up when we have negative downturn in the market, because generally the market goes up slowly and then when it falls pretty hard. And we can see some mispricing and sometimes some opportunity with implied volatility because the market falls quickly for a couple of days and you'll see the implied volatility skyrocket. And then that's probably a good opportunity to, sell a cash secured put over a stock you're looking to accumulate, or, selling a strangle or a straddle and taking advantage of the higher implied volatilities. Would you agree with that, Eason, or do you have any comments?
That's exactly right. And I think, that, I think that's how it was obviously originally pitched, right? So, but the thing is, is like, I think that over time, the interpretation right, has gotten us a bit cloudy, right? Because people don't explain it properly, right? Because when you just say, buy low, sell high, right, then people automatically think, well, okay, right, when implied vol is low, right, I should just be buying, right, right? It doesn't matter nothing else matters, right? Or when vol's really high, right, I'll just be selling, right, because that makes perfect sense, right? But so I think the message, right, it's been lost in translation, right, and it's morphed into this thing. It's morphed into this idea, right, that is I guess somewhat rigid, right, and people forget, right, what the original intention is, right? If you're doing single series options, which is really what it's about, right? All right. If you look at a single series option, right? Yes, right. Selling high vol, right, makes sense running there, right? Pretty much most of the time. Okay, but again, at the same time, right, it's not. It's a supporting factor, right? Yes, I should be selling, all right, vol at this level, but it shouldn't come before. Should I even be in this stock? Does that kind of make sense? All right. So it's not just about. So at the end of the day, right, direction and why am I in this stock right now, right, still needs to come first. Implied vol and how I trade this particular stock that I'm about to go, or how do I maximize how do I maximize my potential profit or my trade, right? What strategy should I use, which makes the most sense? That comes second, right? But a lot of people running that do it the other way around.
Yeah. Eric just asked a question around IVR or IV rank. Eason, do you want to explain that and how you use that to factor in your trades?
So I guess it's like the comparison, right? Like the CSL, right? The IV rank is 4, okay? Which means that, in the last 52 weeks running there, right, it's right against the lowest percentile right in there, right, of volatility, right? So I think the vol was something like 15 or 16, right? Lowest for 12 months, okay? So to me, right, CSL for me personally, all right, is that it doesn't matter what period you're selling it in, the premium on it and the time value that's actually on it in terms of hard dollar value is ridiculous. So say for example, right, if you're trading CSL on a weekly, all right, for 5 days, okay, I think that on day one, if you sell a call that's at the money, it's going to be something like probably somewhere between $2.50 and $3. All right, the time component is absolutely massive. All right, if you get the direction right, right, and it goes in your favor, right, you've collected your 250. All right. So to me, right, right, implied vol, right, right, even though the implied vol at the moment, right, is like super low, right, it doesn't actually mean, right, that the premium is low. I think implied vol, right, is designed, right, in a way so that it's like, okay, if the volatility is like super low, right, is it really worth my while selling it when the implied vol is low? So for example, right, when banks have low implied vol, if you try to sell it out for a week, you're probably getting something like 10 cents. All right. Now, if you get 10 cents running there, right, for every 10 lots, all right, it's not a lot of money. All right. So by the time you start factoring cost and all those bits and pieces, right, the trade's not really worthwhile unless you end up doing a lot of them. All right. So that's where the problem is. But when you start looking at stocks that have a large amount of time value, all right, then it doesn't matter as much, all right, because at the end of the day, even if you do a small amount, right, because you're collecting potentially like 30 to 40 cents running in time decay per day, right, if the stock does next to nothing running right, for 2 or 3 days, all right, it's going to lose running 30%, probably 35% of its value too. And the other thing also running right, with implied vol, right, is that you've also got to consider your days to expiry, all right, because if you think about it, right, if you've got an expiry, right, say in 10 days, all right, you can there's only so much, right, that a particular stock can move, all right, over a 10-day period, all right. You can sort of estimate, right, and say, okay, right, right, if say for, if the stock were to say move, 50 cents per day, say for something like CBA, right, and you say, okay, right, the normal average daily move, right, is say, most of the time it moves somewhere between 50 to 80 cents per day, right. And I've got 10 days to go. All right. As each day comes off it, all right, and the time value decays off it, it means that the next day, right, the time value component is less, which means that the implied vol, right, is going to be less, all right, or it's going to have less effect on the final options price. All right. So if you hold on to it for a week, all right, almost half your time value right now is going to disappear out of it, right? Which means that implied vol, right, is going to play a lesser part, right, in the options pricing right now as time goes on. All right. The big issue, right, is that if you say went for something like I'm going to buy something, or I'm going to sell something that's low volatility, and I sell it into September, right, that's when you get problems. Right, because if you go, all right, I'm going to sell something out into September, right, I'm doing it right when my IV rank is 4, right, I've got something like I don't know, 90 days, right, to expiry, right. If we get a big vol spike runner in between that, right, my options position, right, is going to go from it might go from like $1 to $2.50, right. That's where you start getting problems, right. So it's a combination, right, of right, looking at what the implied vol is today, right, what it's worth, but also looking at how much time, right, do I have to expiry, and if you have a long time to expiry, right, that means that somewhere in between that, if we get a big vol spike, it's going to heavily affect, right, the final price of the position. So I have seen guys running there, right, that say only pure sellers, right, but what they do, right, is they sell far out in time, right, so like 2 months plus, right. The longer your time frame and the lower the volatility you sell, the more risk, right, you put yourself in. All right. So I don't typically have that problem, right, because a lot of my stuff right now that I do, right, I go out in terms of sold position, right, I normally don't go out a month, right, much more than a month. All right. So because I like the visibility, right, I don't like sending stuff running out into the unknown, like months, like say 3 or 4 or 6 months in advance, right, because you just can't see, all right, and that's when you subject yourself running there, right, to or potential jumps in implied vol, and then that obviously only then affects your position, right? And there's often calculators on here that you can you can put it in, right? If you put something in and you test it, and you say, okay, right, I'm doing something that's say 3 or 4 months out, all right, the current vol right, has an IV rank of 4, this is what it is. If you then say, okay, right, if the implied vol run, goes up by, by 5%, right, goes from 15 to 20%, right, and you're out in September, right, you'll see right now that there'll be a marked difference, right, in terms of pricing.
Or you can do that on our platform, Eason, on the strategy builder.
Yeah, I used to do it in the Iris, all right. But if you have something around that, say 10 days out, all right, and you apply the implied vol, right, on that, right, and you say, okay, right, if the implied vol run, jumped up by whatever, right, by 5%, right, but then you add in 2 days time decay into it, you'll find right now that the actual price differential run, right, on the change is not going to be very much, right, because you're close, right, you're close to expiry, right. The thing's losing time decay is copying time decay run at a rate of knots, right, because you're close to expiry. So therefore, right, the time decay, right, negates the implied vol impact, right, on a shorter dated option, right? But it's not able to do that, right, on something that's longer dated. So that's another thing only now, right, where you need to be careful, particularly only if you're a longer dated trader, right? So if you trade longer dated, right, as in 1 month plus, and the longer your time frame, right, the more important, right, implied vol becomes to you, right? That's why for me personally, right, the stuff that I do, right, I look at implied vol, I have an understanding of implied vol, but I don't look at it as much, and I don't study it as much running religiously running as what someone else would do, because my time frame running is just much shorter, right, and it doesn't really impact what I do that significantly.
Yeah. Ivan, I will show you on the platform a couple of different ways to have a look at the difference in the value of options based on, when you're putting the trade on, you can do a stress test or an understanding around how your strategy will change value based on the implied volatility change. And then you can do the same thing within the portfolio as well for a bit more of a complete overview too. So we'll get into that shortly.
The other thing is, just answering the low IV tends to precede high IV. All right. The trouble is, right, is like, your IV rank run in it is going to fluctuate around in up and down. But the thing is, right, there's no preset path. Right. There's no preset right now that, that after a certain number of days running out, right, that, the vol's going to go up. Right. It just depends on what's happening in the market, what's happening in the stock. Right. Nothing is preset. Right. It's just an expectation. And this is why, right, you can't look at IV right now and say that, I'm just going to do this particular trade because the IV right now is at this particular level. All right. Because it's it's not the implied vol that's going to make you the money. Right. It's not going to make you trade profitable. All right. IV gives you potentially a trading edge if you use it properly. All right. The more important thing, right, is actually to get your direction of the trade right. Right. Because okay, let's just think of it this way. If you get your direction right, right, and you totally ignore IV, right, and let's say you paid too much, right, or you received too little, right. So let's say right now, for example, right now, using the bank analogy, right, if you sell National Bank puts right now for 10 cents, right, and you picked up a really crappy IV, right, on your premium, right, because the IV is low. If you get the direction right, and your sold, say you sold call and the stock goes down, you'll still capture your 10 cents, right? You still pull a profit. You won't lose. But the thing is, if in reverse, right? Let's say you sold your call right now at a high IV, right? So what? If it goes against you, right, and it's got $1 in the money, against you, right? What's going to happen? You're still going to lose money, right? Because the IV you're running now, right, will only protect you so much. Right, it only gives you right now that little bit of edge. Right, it's not going to make your trade all of a sudden, click positive running now, right, and bring you a positive outcome, right, just because you got a good IV. So at the end of the day, right, it's trade signal. Make sure you're running it. You got the right direction, right, because if you get that right, you're more than halfway there. Right, IV running it just helps you running there, right, so that you get that little bit extra. Right? Or improve your chances running that a little bit more.
Sure. No, I get that completely, Eason. And especially, if you're in a situation where you're putting a trade on and it is shorter term and it is a credit trade and you're holding it to expiry, like the implied volatility isn't really going to matter at all.
No.
There are some situations where it is going to matter for sure, and you can take the edge for that, whether you're selling a cash secured put or a covered call and you generate some extra premium, or you can go, like say you're selling a covered call, you can go further out away from the money and still get the same premium that you would when implied volatility was lower. So yes, it can play a part, but really think about your strategy overall and think through it logically to understand, is this actually affecting me, and should I put so much weighting on this indicator?
And I encourage everyone, everyone to do the same thing, right? Like, whatever indicator that you're using, whatever theory around, that you're looking at, right? You've got to think, you've got to go, well, okay, right, this is what convention says, this is what it's telling me to do. Does this apply to me? All right. And how's it going to impact on my trade if I do this? Right. If it goes down, right, if it goes up, right, what's actually going to happen? All right. And then once you think about it that way, right, then it all becomes clear. Right. Getting the direction right pretty much accommodates for almost everything. All right. That's why, right, that first component around there is far more important, right, than anything else. Right. IV is a supporting actor. Right. It's not the main attraction.
Yep. No, fantastic. Let's keep on moving, Eason. I'll bring up the volatility website. I think that has been updated. I just guess to finish off the conversation of implied volatility would be, where to find it on the platform itself. So I can definitely show you all how that works. Let me just jump into the watch list. My internet's running a little bit slow today. Excuse me. Click on the stock that you're looking for. You'll get the IV rank in the stock overview page right here. And you can click the volatility tab, which is the third tab over. And this will show you graphed implied volatility of this stock over the last 12 months. So remember, this isn't the historical volatility of the stock. This is the implied volatility of the stock. So it's graphed as what the market expects is going to happen to this stock over the next period of time. And this IV rank number is derived from this chart. For example, I'm with the XJO now. If implied volatility was 9%, which was the lows here, kind of the start of December, IV rank would be 1. That's the lowest point over the last 12 months. And if implied volatility got up to the peak in here, which is the end of October last year at 15.39%, the implied volatility rank would be 100. So that's how this IV rank number is determined, and where you can see it on the platform. Probably just the other note as well, Ivan, I'll answer your question around the change in implied volatility. I think you're speaking about the stress test, which is in the portfolio. You can definitely click on the stress test button when you've got your positions open and adjust the volatility to see how that will affect your overall portfolio. So you can use that. But I wanted to show you, before you put a position on, and I'll just put a dummy position on here, maybe CommBank long call. This slide here will affect your payoff diagram based on the implied volatility. So I'm not sure if you can see this here, but it's Commonwealth Bank's current IV is 16.5, and that's graphed here. You'll be able to see the value of the change of the option over time on this payoff diagram here between now and expiry. And you can see if there was a change in the implied volatility, how that will affect your option over time as well. Obviously, it's not going to affect it all at expiry because the implied volatility is not going to matter. It's going to be the price versus the strike price. But in between, It's important to know if you're looking at, trading in and out of a particular option. So have a play around with that. All right, back to the session, Eason. Is there a stock you wanted to start off with to have a look at today?
Oh, let's start with JPH right now because I sent that out yesterday, so may as well go there first.
Yep.
So look, just straight up, right? You can tell, right? That it looks like a triple top. All right, so we've hit $65 on it or thereabouts 3 times. All right, so and it looks like it is failing, so that's why I went in on that. When I put it on a 4-hour MACD, it also was suggestive right now that it had hit the top as well. All right, so I quite like that.
I'll just bring that up as well.
Yeah. I'll just get it on mine as well because I can't see it. No. 4.
Yeah, get that up on your screen as well. But we can see a bit of we've gone from the green.
It's
green
falling
down to the red. Yeah.
So it's starting to fall, right? So at this stage, and it's falling from a very high level as well, right? The last couple of days, only right? It's gone. The JBH has gone particularly a bit crazy. All right, so it wouldn't surprise me around right, that it continues to fall. Sure, it's bounced back a little bit today, but I think overall, right, that the thing has already confirmed. And I expect, right, that in due course, right, it will continue to weaken and ultimately, finish up below $62. So I'm quite okay with that one.
Sure. Just for anyone that didn't or isn't part of the trade ideas access, Eason, what was the trade that you put on? How was it structured?
It's 62 and 64. So selling $62 calls, buying $64 for protection.
Okay, so your profit is anywhere below the $62?
Anything under 62, right? I think when people were doing it yesterday, around, I think they were getting around about 80 odd cents anyway. 80 to 90 cents, somewhere in there.
Okay, and how much time did you put on this spread?
End of July.
Okay, so a month.
Yeah, some. That was the only choice anyhow. But I think it gives us plenty. That will give it plenty of time, right, for it to do that. If you look at historically, the way it's trended after a turn, it does tend to come off quite a bit. If we can use the last time it fell away as a benchmark, right? So it's certainly volatile enough. But yeah, so at the moment it's doing okay. Right, and I expect in the coming days, right, it will continue to soften up.
Fantastic.
Probably should have a look at MIN, which is the unfortunate one. I was a day early on that. So I put that on 2 days ago. All right, and then yesterday, or was it yesterday? It gapped another, I don't know, I think it gapped another $5 or $6 on me, right? But the reason why I got into this one, right, is the same thing, right? The MACD running there was super, super low, right? It's the lowest, it was the lowest it had been, right, for 12 months. So when you throw it on a 4-hour, chuck that on a 4-hour, Blake. Let's bring it up on mine as well.
Yep, I already had it on the 4-hour.
Right.
So we'll have a look at this.
So on my chart running now, I can only bring it back on about 12 months, right? But it was at like -3. It's now at like -4, right? On the indicator, right? It's now significantly lower than where it's been on for the last 12 months, right? And I just don't think there's much more room for it to go, right? On a momentum basis, right, it is ridiculously oversold, right? I believe the reason, right, for that big spike down in the last couple of days, in the last day or so, was that there was I think it was Morgan Stanley, right? They published a report that they expect that lithium, the take up in electric cars right now is going to be a bit slower, right? Which is going to obviously affect right now, right? The price of lithium and so forth, right? And that in turn, right, hit the entire sector. So this is not a mineral resources problem, right? It is a sector-wide problem, right? So it hit the likes of IGO, PLS, and all those guys, right? But look, to me, the report came out only a couple of days ago. If they put out the report on, when the stock was $80, right, it's one thing. It's a bit odd for me, right, to bring out a report after the stock's dropped almost 30%. So to me, I think that there's a much bigger probability of a bounce at some point. If we throw that onto a daily, just switch it over to a daily, and we have a look at previous turnarounds in MIN, right? The rallies are typically quite significant, right? So once you have your MACD turnaround, and it'll be the same for your GMOF area, it'll just be a little bit later, right? But once they turn around, the stock will typically move right $10 plus, right? When the turnaround finally shows up.
Yeah.
I'm still pretty.
Yeah. Sorry, I was just going to ask. Remind everyone what type of trade you did put on for MIN.
It is a bought call. It was a bought call at 59, right? But I took it out for 2 months. Typically, with most of my bought call, bought put positions right in there, I always try to give it extra time, particularly on entry, because there's always this. I always worry around that that the timing might be slightly out, or that something outlier might occur, right? That will that will cause a problem for the trade. In this case, that's exactly what's happened, right? Something funny has occurred. A report's come out. But I think it's nothing that a few days right won't smooth it out. All right. So once this this report's been digested, right, and that's out of the way, I think that the stock will turn, all right, and it will it will rally back up. The other thing also, right, is that I am aware of guys that are already in the MIN. I will be calling them at some point, possibly, right? Because I may look to restructure the level of the trade given what's occurred. Okay.
Yeah.
So, but I'll talk to you guys individually about that. But it'll be something to the tune of potentially rolling down the 59 to a closer strike. But we won't do that until we see more definitive signs of the turn. All right. So, but that is something right, that that's on my watch list anyway.
Cool. I had a question just a little while ago from Pedrom. If you have conviction on a stock falling, why not just buy a put rather than a spread? That must have come through when we're looking at JB Hi-Fi, Eason, but probably a good question. Like, how do you determine when you're just going long an option versus putting a spread trade on?
It depends on a couple of factors, right? So I try not to. So as a general rule of thumb, right, I try not to do too many bought calls and bought puts, right, to start with. All right. So this comes down to a couple of things, right? First thing I know is that I prefer to do more trades, right, where I have more factors working for me rather than against me. All right. So I know I've harped on about this concept right in there on a couple of webcasts, but it's super important. If you trade a spread, or and certainly around the way I set it up, right, I typically try to have the time value working for me, right, and I try to get the direction of the market right. Okay, so I want two factors working for me. Okay, when I buy a call or when I buy a put, right, I have two factors working against me. A, the stock might move in the wrong direction. B, I get burnt by time value. Okay, so for that reason, right, I try to do more spreads, right? So call spreads and put spreads, right? Because I think there's a higher probability, right, of getting the trade right. Okay. Yes, from time to time, right, right, if I get something high conviction, right, I will go out for a bought call or a bought put, right? And I would need the signal to be fairly strong. So I look for significant overboughts, significant oversold, right, and areas, right, where there could be potential for strong turns. Okay, that's why I do it that way, right? Because sometimes right, it's not just about conviction, right? So I have conviction, right, on every single trade I do. That's why I do them, right? That's why I send them out. But the thing is, I won't get them all right. Right. So you got to take the view, right, that you can't make every dollar on the market. Right. You're not going to get every trade right, but you want to try and do it right in such a way so that you get as many right as possible. Right. Because at the end of the day, right, right, the common denominator here, right, is we're trying to grow, right, the portfolio balance. Right. You want your balance to go higher. At the end of the day, it doesn't matter how it's done. It just needs to go up. All right. So I'd rather put on a few extra trades, right, that are higher probability of that have a high probability of success, rather than going, all right, I think this thing's going to bounce 10 bucks on or I think this is going to go up $5 and I'll just buy a call or put every single time. So that's the way I look at it.
Yeah, no, that's good. Ivan had a few points. Min closed a mine somewhere, which probably didn't help. Yeah, probably true. If there's any corporate actions or announcements coming out.
Yes, sometimes. But
Sure.
on the day, right, I looked at all the other all the other guys in that lithium space, right? They all were down like 6%. So it wasn't that problem in particular on that day anyway.
Yeah. Ivan also mentioned bull puts. I understand with bull put spread with two direction in your favor, but not a bull call because you still need movement.
No, that's not 100% true. Right, that's only a half truth as well. Right, so it depends. So if you can do it as a bull call, but it depends on how you do it. Okay, so the way to think about it, right, is so there's two ways you can structure a bull call. Okay, so let's use MIN as an example, right? So the share price is currently 55, correct?
Yep.
Right, or thereabouts. Okay, so if you went and bought a bull call spread, right, starting at 55, so you say buy a $55 call, and then you say sell, let's say you sell a $60 call, okay, then the answer is yes, you would need the stock to move up, right, in order for you to pull a profit, right, because you're starting with zero intrinsic value on your 55, right, and you need the stock to go to 60, right, in order for you to hit maximum profit. Okay, so yes, that is a directional bull call spread. Okay, but it doesn't have to be that way. Okay, as an example, right, let's say you go the other way. I buy a $50 call and I sell a $55 call, all right, then that means I'm buying my call that is going to be in the money, all right, very low time. And then I sell my $55 call, which will give me the time value. Therefore, what will happen, right, is that if the share price stays at 55 or above, I'm going to profit from whatever time value is on that $55 call. Have I lost anyone? All right, because
I've just structured the trade as you were talking about it, Eason, and I've done the bull call spread at $50 bought call, $55 sold call, and you can see by the payoff diagram it kind of explains what you're talking about. The current price is at that $55, and you have positive time decay.
Yeah, correct. You have positive time decay, right? It depends on how you. It ultimately comes down to how you structure your trade, right? So if you think about it, right, in a way, selling a $55 put protected at 50 is no different to buying a call at 50 and selling a $55 call. Does that kind of make sense? Right? It's essentially the same trade, right, with the same payoff. Right? It's just that you're doing it, right, from a different angle. Yeah, Brad, that's exactly right. Right? If you debit and credit spread, right, right, IV it's not completely unimportant, right, but its importance, right, is significantly diminished when you do it as a spread.
Yeah, there'd be some other factors around, the price of the puts and the calls, I guess. Obviously, one's naturally a debit spread and one's a credit spread as well. So it could probably affect your margin a little bit too, Eason. So it's going to depend on your structure of your portfolio.
Correct. Margin, capital, whether you're collateralized, right? There's a whole bunch of other factors on it that go into it. But if we're looking at it from a pure play, risk reward, you can structure it, right, the exact same trade, right, with the exact same payoff, right? Because call spreads are not always going to be time negative; they can be time positive, right? And likewise, sold spreads aren't always time positive either, right? If I sold a $60 put protected at 55, I'm time negative. It's the same thing, right? So it really comes down, right, to how you structure your trade, right, and what your expectations are for that particular trade.
Yeah, no, that makes a lot of sense. Okay, great. Is there any other stocks you want to discuss while we're still here, Eason?
Well, no, not particularly. I know if unless anyone else has got anything they want to ask. Just
I know
taking
we're a little bit over time, but I don't know. I haven't really tested the system if we're running over our allocated time. But if we've got another 10 minutes, we can probably keep going. Just before we get into these comments, and thanks for putting them across. Eason has a trade idea service, so any of the trades that he's putting on or for his clients, he'll send out and notify people that are interested, such as the mineral resources and the JB Hi-Fi one that we looked at today. Plus, you've been doing this for a couple of months now. So anyone that wants access to those, maybe just type yes into the comments, and I'll give you a call and provide some more information about that. Or give me a call on our phone after the session, or just send us a message as well, and I can coordinate that with you both as well. Okay.
Let's rule the line off there at Rio, right? And I'll talk about all those things really, really quickly, right? So, starting with Woolies.
Yep.
I think Woolies is definitely a hold. So for the guys running there, right, that weren't aware of the trade idea, I think the entry point was around about that $31 mark, right, where we went in and bought a call. Some of you guys did put spreads, right? But ultimately, the stock's up a lot, right, off the back of a Ichimoku tri-level break, right? We got 3 signals coming out of Ichimoku along with the MACDs and so forth. I think that there is more juice in it. Historically, right, when we have this type of break, the stock tends to grind higher over a sort of medium length of time. Now that's medium run, in trading terms. Okay, so over the next couple of months is what I'm getting at. So I will probably review it if it gets to around $35. I'm not saying I'm necessarily going to take profit. It will depend upon how fast it gets there, and how much time we have left on the actual, in terms of days to expiry. But at this point in time, I think it's got more juice. Okay. In terms of general commodities, right? So if we just bring up Rio, Blake.
Yep.
Okay. I like Rio. I like everything around in that commodity space. I think around in that it is building a really, really nice base at the current level. The 4 hour certainly says around that we've hit bottom. We've already dropped like, $15 or so. The guys that are that went short on the initial trade idea around some guys did really, really well, right? And I think around that where we are now, we will see some sort of a turn at some point. I think it's already in that process now. I think, and ultimately, I think it potentially could come back towards 125. But again, with momentum type trades and momentum traders, right, it's difficult to say how far up a particular rally is going to go. It just depends on how it moves and how quickly it moves. But in short, at this point in time, I'd rather be long commodities than short.
Right. Would you say the same thing for FMG, Eason? Is that a stock that you cover?
Yeah. Yep, FMG will be the same, right? BHP right now will be very, very similar, right? They all move in a similar sort of way, right? So without even I have looked at FMG as well. I've got a couple of guys on right, looking at wheel strategy on FMG at this level as well. So we are, looking to sell puts to potentially buy stock, in that commodity space. All right. So I've got guys doing BHP, some guys doing FMG, and so forth. And some guys just buying outright stuff. Right?
Yeah. If you want a bit more of a deep dive on Fortescue, Jimmy and I on Friday probably spent 15 minutes talking about FMG and his price targets, and how he's trading it at the moment, whether he's capturing the current momentum or looking at different strategies to get long stock for the upcoming expected dividend over the next couple of months and earnings and the rest of that. So if you want a a bit more of a deep understanding and analysis of FMG, have a look at the recording of the Friday session, I would say, and that should give you a bit more context around what's going on.
Let's have a quick look at CBA very, very quickly.
Yep.
CBA is a really difficult stock to trade, particularly of late, right? Because there's a couple of problems with it, right? Right? Apart from the fact, right, that it's the most expensive bank, right? On the exchange and probably around the world, right? It's also now getting to that stage, right, where it's like ridiculously overbought as well, right? So, the other thing also right now is that, from a fundamental perspective, right, it's something like 21 times earnings, which is like ridiculously expensive as well, right? In the past, right, right, it's even when it's outperformed the other banks, right, the valuation right now hasn't really gone much above 18 to 19, right? This time around, it's gone up to 21, right, which is pretty much unheard of right now. Well, as far as I understand, it's never gotten this expensive since it's been listed. So I just think that I'm basically selling calls either at the money or near the money, right? As long as it continues to remain expensive. All right. So I'm not expecting it to fall in, whilst I'm not expecting it right now to fall into a big heap as much as I would like it to, right? But I think at this level, right, there's not a lot of upside. And that if you, generally speaking, sell time, right, against the CBA, I think right now, right, you'll become profitable, right, in the right volumes. Right, so not too aggressive, right? But selling some sort of a call spread right, right over the top of it, I think is the way to play it. I certainly wouldn't go long at this level anyway.
Sure, and I know we were looking at CBA maybe 3 or 4 weeks ago, Eason, and you talked about a bear call spread. For anyone that had probably been chasing selling calls over the last, I don't know, 2 months, 1 month or so. What's your consensus on that? Trying to just keep rolling and wait for the stock to get onto the right side.
So that's kind of what we've done running of late. So I've spoken to those guys individually, right? And we have tried to push it out a little bit further into time, take up the strike running right where we can, right? Even if it means taking a small loss, right, on that. Right, but to me, right, right, the way it's moving, right, the sharpness, right, right, of the rally, right, going from 117, right, to like 128 over a very, have a look at it. It's like 15 days, a little over 15 days, right. It's not really moving typically like a bank either, right. It's moving. The way the sharpness of the move right, right, is almost like a growth stock right in many ways, right? And I just don't think CBA right is is a stock that's in that space, right? It's one of the more mature stocks, so I think that slowly massaging the position out, right, and continue to sell over the top of it, right, is the right strategy to be in for the CBA. Right. And look, the last how many days? The last 7 or 8 days only, it hasn't really gone anywhere. Right. So after that last big gap up, right, the stock hasn't really gained much more ground. So there's potentially running there, right, some selling on it around this level anyway. So it's a time play. Right. I wouldn't rush in running it to buy puts on it, right, necessarily. Right. But certainly running there, right, some sort of time spread, a call spread of some sort, I think is the way to play it.
Yeah, and I really think, especially for the banks and CBA, Eason, come earnings season, which is only really 6-8 weeks away, it's going to be a really big factor in determining which way these stocks move over the next period of time, because there's a lot of assumptions with the price growth at the moment. But when the data actually hits, it's going to be a significant catalyst for the future of these companies.
It certainly is, right. And the last time CBA reported, right, the stock was like 115, 116. Right? After reported, it went to 110. Right, post report. Right, and now we find ourselves around $13 higher, in a couple of months. So so was the result really that bad, right? But I don't know. The valuation just doesn't look right. The momentum running now, right, is too crazy right now, and I think that these periods will pass. And time is what's going to smooth it over, I think. Let's go with the last one. Let's have a quick look at TW, and then we'll wrap it up.
Sure. Is this a stock that you follow,
No,
Eason?
it isn't. Right. Treasury wine zone is something I know that I look at, sort of every 6 months. Right. It's not one that I really look at. To be honest, right, I don't really have an opinion on it, right, because it's not really in a space running there, right, whereby the trouble is, right, it's not really an uptrend, it's not really in downtrend, right? It's sort of stuck. It's stuck in between. So we'll look at TWE on my screen here.
Yeah, I might put some indicators on as well, Eason. Maybe your common indicators, the Ichimoku cloud, and maybe a MACD. We can do it. You can do a bit of a live analysis.
Looking at the daily, right, in the general sense, right, I don't think running there, right, it's a stock runner that you want to be short in very general terms. There's nothing to suggest running there, right, that the stock's in trouble. In terms of the cloud, it's above the cloud, right, which suggests running there, right, there is going to be support on it around, those levels there. The key point running there will be that is that 13. I think it's 13. Right. Above $13, obviously, will mark a breakout. It might move further beyond that. For where it is at the moment, right? If I was to trade this stock at the minute, I'd go in run out as a put spread. So like a bear call spread of some sort. That's the only way I'd play it. I wouldn't rush out and buy calls. I wouldn't rush out and buy puts. I'd run it as a spread. The trend's not strong enough runner for me, to be going along with the call. But if you said to me, the stock's got limited downside in the short term, I would agree with that.
Yeah, sure. No, that's a good point, Eason. And I guess your terminology around when you said, or when you were kind of explaining what you would put on, are you just saying that for the sake of looking at the chart at the moment, is Treasury Wines just a stock that
no, it's not something
you don't touch?
It's not that I don't touch it right now, right? It's just that it's just not something that I just haven't traded in the past. It's something I haven't traded in the past.
Well, you don't have to trade everything.
Well, you can't trade everything to begin with, right? But typically, I prefer to trade the big four banks, BHPs, Rios, right? Something with a bit of volatility, something with a bit of extra time, something with slightly better liquidity, right? Because sometimes the ones that are less popular, they can squeeze you a bit more. So there's a bit more in slippage, right? Treasury wines will be one of those, right? Where you could find yourself running having to pay a little bit extra to get in and out. So for that reason, for those types of reasons, I wouldn't necessarily go into it. But like I said, if I were to trade it, right, and I had to trade that stock, that's the way I would play it.
Sure. No, and that's a good point, Eason. And I guess just because there are so many stocks out there to trade doesn't mean you have to trade them all. And stick to the stocks that you know well. Like sometimes also the best trade is not to place one at all and wait for the right indicators and the right setup before you do trade. And we know over the short period of time that you've put trade ideas out, Eason, you're pretty strict in what stocks you are trading, and you're really waiting for the stock to line up with your own trading plan, and you have that natural conviction once it's priced up the way that you're looking for as well. So it's just important to consider and stick to what you know, and trade what your trading plan actually says, and you don't need to go further away than that. Not to say that you should never trade TWE. I'm sure there's people out there that just trade TWE and do really well. But stick to what you're comfortable with.
Absolutely.
Yeah. All right. Very good. I think we'll finish off the session now. We did go a little bit longer, but I don't think anyone jumped offline, Eason. So maybe that's a case for us to run longer sessions depending on your schedule. But no, thanks everyone for sticking with us. We had a lot to cover today. I'd probably even make an argument to have a part 2 on implied volatility based on how much we spoke about at the start of the session. These sessions are every week, so lock this time into your calendar and jump on next week. We'll have a new conversation and an update on the market for next week as well. Any feedback would be great. I know we're not struggling for ideas, Eason, but we make these sessions for everyone that's watching, right? So if you've got any suggestions around what we can focus more of, or any slight alterations, we're always willing to take that advice and make these sessions better. And thanks to you, Eason. Thanks again for taking the time out of your week to jump online and show us all what you've been up to. And thanks everyone again. Enjoy the rest of your Tuesday, and I'll catch you next time. Cheers.
Thanks, guys.